All right, we have got to talk about this. We're diving into the absolutely unbelievable story of Avis Budget Group, ticker symbol CAR, and a stock chart that has basically thrown all the rules out the window.
Just take a second and let that number sink in. 600% in 1 month. We're not talking about some obscure crypto coin here. This is a major, well-known car rental company. It's wild.
So yeah, that's the million-dollar question, isn't it? How on earth did this happen? What kind of market force could possibly send a stock flying this high this fast? Well, let's break it all down. First off, you gotta understand just how fast this all went down. This wasn't some slow, steady climb. Nope, this was a straight-up vertical explosion that left even the most seasoned traders completely stunned. The momentum was just staggering. It wasn't just a single good day. We're talking about a massive 23% jump on a Monday, and then boom, another 18% surge the very next day. When you see back-to-back moves like that, it's a huge signal that there's something else going on under the surface. So what is that something else? Well, the engine powering this entire epic rally is a classic high-drama market event called a short squeeze. Now, to really get what a squeeze is, you first have to understand short selling. Think of it like this. It's basically placing a bet that a stock's price is going to go down. An investor borrows shares, sells them right away, and then hopes to buy them back later when they're cheaper. If they do, they return the shares and pocket the difference. And the scale of the bet against Avis, wow, it was just massive. A full 25% of the company's stock was sold short. Let that sink in. For every 4 shares out there, 1 was tied up in a bet that the company was going to fail. And just to give you some context, anything over 10% short interest is usually seen as pretty high. It gets people talking. So at 25%, you're not just playing with fire, you're sitting on a keg of dynamite. The pressure on those investors betting against the stock becomes absolutely immense. And this is where it gets wild, because all that pressure creates this insane feedback loop. It starts when the stock price starts to nudge up for some reason. The short sellers, they immediately start losing money. To stop the bleeding, they have no choice. They're forced to buy shares to close out their bet. But wait, all of that forced buying creates even more demand, which pushes the price even higher. That, in turn, makes more short sellers panic and buy, and you see where this is going. It's a powerful, self-feeding cycle that can send a stock to the moon. All of this leads to a really fascinating situation, a total disconnect. What the stock's price is doing, the technicals, has become completely unmoored from how the actual business is doing, the fundamentals. I mean, just look at the difference between Avis and its competitors. It's night and day. Over the last year, while Avis has shot up over 500%, its peers like CarMax and Carvana are actually down around 30%. This is not a rising tide lifts all boats scenario. This is one boat getting strapped to a rocket while the others are sinking. So what gives? Why the huge split? Well, Avis's crazy climb is being driven purely by those short squeeze mechanics we just talked about. Meanwhile, its rivals are dealing with real-world business headaches, like a glut in the used car market and the pressure of rising interest rates. And let's be clear, it's not like Avis is a perfect company with no problems. Far from it. They're dealing with their own major headwinds, like the rising cost of cars for their fleet, pressures on the labor front, tons of competition from ride-sharing, and a pretty hefty load of corporate debt. These are not the signs of a business that should be fundamentally worth 600% more than it was a month ago. So this brings us to the flip side, the inevitable risk. Any rally that's built on a foundation of pure speculation instead of actual value is, by its very nature, incredibly unstable. And when these things unwind, the fall can be just as spectacular as the climb. And you don't have to take my word for it. History gives us a pretty stark warning here. Rallies driven by short squeezes have a very clear and often painful pattern. Once the buying frenzy runs out of steam, it's not unusual to see them crash back down, losing 50, even 80% of their gains. And the reason why is actually pretty simple. The whole rally was fueled by a temporary and, frankly, artificial source of demand. All those panicked short sellers. Once they've all bought their shares back and closed their positions, that intense buying pressure just evaporates. Poof. The rocket simply runs out of fuel. Okay, so if you're watching this incredible story play out, what are the key signals you should be looking for? What tells you that this wild ride might be coming to an end? You're going to want to watch 3 key things. First,
Keep a close eye on the short interest data. If you see that number start to fall off a cliff, that's a huge sign the squeeze is losing steam. Second, the company's next earnings report is going to be a massive reality check. And third, watch the boring stuff, the core business numbers, like actual rental demand.
So what's the bottom line here? It's pretty clear. The current price of Avis stock is a reflection of market mechanics and pure speculation, not the underlying value of the company. This is the very definition of a high-risk trade, not a stable, long-term investment.
And that leaves us with the big question, right? When all the dust finally settles on this, what will the story be? Will people look back at this chart and talk about the incredible gains for the traders who timed it perfectly? Or will this become the new textbook example of a cautionary tale about the dangers of speculation? I guess only time will tell.